This is an audio recording of the LendIt Fintech Weekly News Show. The show is streamed live on LendIt TV, LinkedIn, YouTube, and Twitter at 5 p.m. Eastern Time every Thursday. In this fast-paced show, the LendIt News team and a special guest discuss the most important fintech news stories of the past week. Good afternoon, everybody, and welcome to the LendIt Fintech Weekly News Show. My name is Peter Renton, Chairman and Co-founder of LendIt Fintech, joined as always by my good friend and colleague, Todd Anderson. How are you doing, Todd?
Well, Peter, how are you?
I'm doing great, and also joining us again is Kabir Kumar. How are you doing, Kabir?
Great to see both of you. Thanks for having me back.
Of course. Why don't you just give us a little bit of background of what you do, like 20 seconds?
With Flourish, we are a venture capital firm that backs entrepreneurs with purpose, and I'm based in the DC area. And invested in Alloy, Hummingbird, and in broader B2B infrastructure fintech space.
All right. Well, thank you for that. Well, let's get right into it, and let's talk about. We're going to start off talking about the SEC, and this was an interesting story that came out earlier this week, where there was a whole thing, and there was a big thing in the Financial Times talking about just the new rules that the SEC is they've created these new rules for exchanges. Didn't really mention crypto, but it looks like it's targeted at crypto. It's a pretty interesting kind of move, and it makes it seem like, there's, they want to sort of protect the investor. I don't know how many investors are actually going to the SEC asking to be protected from crypto trading, but anyway, the SEC, it looks like they're trying to make some moves here. What do you guys think?
I'm a little befuddled. Why I don't know why they don't just call crypto out and say,
right,
this is for crypto exchanges, or this is a step in the direction of more investor protections, and we want to start to get a sense on how these exchanges are working and what other potential safeguards that need to put in place that people don't lose their life savings. Instead, they're like, well, we're just broadening the definition of what an exchange is, and communication protocols, and what a buyer and seller and agree to a price. It's like you're calling it out without calling it out, which I think was kind of silly. And it's almost 700 pages, I think, what they put out, and that they don't actually mention crypto, which is kind of hard to do in 700 pages if you're talking about exchanges. But I think the reaction from the crypto industry told you a lot, in that there's a lot of fear in the space, at least in some corners of it, that this is completely directed at them, even if they're not saying it. And so I think it would be significantly more beneficial if they were just to say, let's get a sense for how these crypto exchanges work, and we don't want to kill them, but we want to see what safeguards are missing.
Yeah, I think part of what this is that to understand how rule making happens and how regulations come into play. I think this, if I'm not mistaken, actually goes back a few years. This is a 2020, if not earlier, sort of process to bring in all of these platforms that trade treasuries. What is this $23 trillion treasuries market under the purview of the SEC? So this has been in the works for a couple of years, but they've sort of taken this moment to potentially use this rule-making process to expand the definition of exchanges, right? And I think, and that's what got people nervous. And in fact, it started with the one Republican commissioner voting against it. I forget her name. I think she's affectionately known as Crypto Mom, if I'm not mistaken. Hester, exactly.
Yep.
And I think she was the one who sort of said, I'm not sure about this because it might expand our purview, and we haven't figured out what that means. And so I think that's what's got people nervous. I think it just speaks to the broader issue of trust right now, right? I think that's what you were getting at, Todd, is that we are kind of firing lots of shots. Gary Gensler is saying a lot of things, but we're not systematically taking action, it seems. And then we are leaving a lot of question marks, a lot of uncertainty, a lot of nervousness around it. And so I suspect this is not really going to matter for the crypto world. This is my guess. I could be wrong. Don't jump at me. But I think it speaks to the broader trust issue.
Right.
And that's what makes it interesting.
Well, sorry. What I was going to say is most of what the crypto industry wants is just clear definitions.
Yeah.
It seems as if the things they get so worked up about is that there's like this, dancing around the edges and kind of, all right, well, we want to kind of oversee this, but hey, let's not get too, it's like, tell us what box we need to work within, and we'll innovate inside that box, and hopefully we can expand that box in the future. But tell us the rules.
Yeah, and less threats, more action, right? If there's a lot of threatening, there's a problem there. Well, okay, what is the problem? Let's solve it.
Yeah.
And I think this is a broader issue with regulation, and especially in this country where clearly we want industry to do well. So let's try and sort this out.
Right.
Faster rather than later.
We have to put a comment here. I'm going to show the comment from Bo Hesterpurse for president. Yes, indeed. She is one of our supporters certainly inside the SEC. But we before we move on, we should be clear. These are proposed new rules. These are not new rules.
Exactly.
There's a 30-day comment period, and so we'll see. We'll be following what actually comes of this. Anyway, moving on. Really good article by Penny Crossman this week in American Banker about Silvergate, and they've bought they've bought the assets of Diem. And now have a whole bunch of intellectual property surrounding stablecoins, and their goal is to issue a new digital currency, new stablecoin by the end of the year. That's what the government wants banks to be the ones issuing stablecoins. So we've also got the move from Figure as well. There, they've got a consortium issuing stablecoins, but Silver Lake, it's in Silvergate, I should say. It's not Silver Lake. But anyway, they are, they're going to be jumping into the game. So the Facebook's Libra that was started off many years ago is still not completely dead.
Yeah. They approached us, at Flourish. We are backed by Piero Midyar, founder of eBay, and they wanted us to be sort of part of this. This is the Facebook Libra team. And, I struggled to get excited because they wanted us to sign an NDA to tell us how it could help financial inclusion. So I was struggling with that logic.
Right.
And so I think, Facebook Meta has been historically very tone deaf, right, about all of these things. I think there are a lot of stories about their missteps with regulators. And I think the fact that we had that White House, right, stablecoin paper that said that stablecoins would be issued by banks,
right,
has set a direction. I think the article mentions that dialogue with the Fed was just going nowhere, and so they've sold it to Silvergate. They're winding down the association. I think on the Silvergate side, it's kind of exciting because they have the Silvergate exchange network already, SEN. I don't know if you know about this. So, you have like Coinbase, Gemini, a few of the other platforms that are already on this network. And they have sort of business accounts with Silvergate, and they're able to move money on this network through their business accounts. Mm-hmm. So they're already in this game, so to speak. And so if they could potentially leverage this technology for, as they are claiming, across these other platforms, I think they mentioned Uber, Lyft, so on, for the movement of money, that's super exciting. And if you remember in the Libra white paper, there was some interesting notions around identity management.
Right.
And so I'm excited to see how that translates into the Silvergate world, and what that means. So So the technology lives, but the botched execution. We're not going to let Facebook off the hook on the botched execution.
Right. No, and the beginning, it was all about financial inclusion. That's sort of what Mark Zuckerberg was saying. That was going to be the big, and managing identity. And
Peter, I was in India. Sorry, Todd, just one.
No, go for it.
I was in India when Mark Zuckerberg wanted to bring Facebook Zero to the emerging markets. You remember Facebook Zero? Facebook Zero was like cheap, zero cost internet access, but you start with Facebook, and it was, again, very tone deaf because it wasn't
like AOL.
Internet. Yeah, it was,
like
but
AOL.
It wasn't the internet. It was Facebook, and like they were like, we are bringing the internet to the masses, and everyone was like, no, you're bringing Facebook to the masses. That's not the internet. And I feel like that was the same kind of approach to Libra, where instead of leading with the technology, they led with this sort of half-baked notions about inclusion and sort of the force for change, when in fact the technology itself was exciting, and that could have been a big story in the industry. So
I was just going to say, I think the the two most interesting things in the piece, at least for me, outside of what you've already mentioned, was them saying that they're going to bring, or they're hoping to bring, this new digital currency to the masses. So obviously a step to continue to push crypto into the mainstream. And then I thought this quote, they're looking to get outside the credit realm and outside the specific ACH rails and just use a tokenized dollar on the internet.
Yeah.
I mean, when would you ever think a bank CEO would say that? I mean, I think it's fascinating to hear from someone. And Silvergate's been known as more of a forward-thinking bank, and I've talked to a few of the execs over there over the last couple of years. And but just hearing that from a bank CEO, it's that type of stuff is what makes you excited,
right?
And what regulators really should be encouraging within the banking system, within the banking community. Here's a bank to set some sort of a vision.
Yeah. Anyway, we got to move on. So, talking about article in Financial Brand about Chase, why Chase's technology can compete with and outperform fintechs. Now, there was talk about Chase when they announced in their earnings call how much money they're spending, but they claim that startups are at an inherent disadvantage. And sure, Chase, they said they have 58 million digital accounts, so they are the largest digital bank in the country. But I don't know. I would not agree. I don't think with the premise that the startups are at. They obviously have some negatives, but I think they certainly have a lot of advantages that Chase doesn't have.
Yeah, I think you have to remember an organization of that size is effectively very bureaucratic.
Right.
I mean, the culture of change is very, very hard. And there was this moment right in the pandemic, if you remember, all those this is 2020, in the sort of the beginnings of the pandemic, when all those Italian banks had to just go online overnight, right? Just over the weekend. And it felt like this would push globally the banking industry to become far more aggressive on digital. And it has had some impact, but it hasn't been that extraordinary as we all thought it would be. And it's partly because they are large traditional organizations where that culture of change is not very hard. Look at how Goldman pursued Marcus and how they went about it. Tells you a lot about it. So I think that's just a silly remark in some ways, because he's basically saying in that article that, we have a lot of customers, so if we launch something, it means a lot. And so fine. But the fact is you struggle to launch things. And that's what you should be asking, why? And, and I think that starts with changing the culture. I think at the same time, I like some of the other things Chase is doing. They're supporters of the Financial Solutions Lab, for instance. And I think they've built a little sort of, venture space within the bank to try and push into new ideas. Mm-hmm. That's good stuff. They should do more of it. They should back that team more, frankly, because I think that's going to be a big part of the impact on the future.
Right.
I actually thought in reading the article that the bankers that they interviewed actually slipped up a bit. Because in one of the quotes, he says, when the bank gets it right, the impact is extraordinary.
Extraordinary.
But when does the bank get it right? I think that's the key, because yes, while technically they would, millions of people or millions of customers, millions of businesses can be impacted, the banks rarely swing and get it right away. Fintechs are a lot more quick to say, all right, plan A didn't work, we'll go to plan B and C, which are already kind of in motion. Or the bank goes, all right, plan A didn't work. Okay, 18 months, we'll have plan B ready to go. And so I thought it was kind of interesting to read the article and see that subtle when they get it right.
Yeah, and there's a great example of that. I don't know if both of you are ready for this. Drum roll, overdraft. I think the change in the banking industry on overdraft it wasn't internally driven, right? It comes from competition, it comes from the policy push. And it was a no-brainer for customers. This was like the thing that could make a huge difference for customers, but they didn't go for it, right? Until these pressures emerged. Yeah. So I think that sums up a lot about how these banks will innovate. Yeah, I know you guys wanted to avoid mentioning overdraft, but
oh no, that's all right. We love overdraft.
Keep our streak going now. Now we keep our streak
Keep our streak going. Okay, let's move on to big funding rounds. We had Sequoia leading a $450 million investment into Polygon. It's a layer 2 blockchain network that I've used personally and I really like. I think it's excellent. And they are now a unicorn several times over and are very much poised to do very well in the future of DeFi, decentralized finance, which is where Polygon really is positioned.
Just a quick it is actually Sequoia Capital India.
Sequoia Capital India. Thank you.
Just quick clarification.
Yeah,
but
Indian. I think it's an Indian firm, if I'm not mistaken.
Yeah,
yes.
It's run by Indians anyway.
Yes.
This is the next iteration on blockchain and Ethereum, which is layer 2. And you see it there. It goes from what is it, like 10 or 15 transactions a second to I think they mentioned in the article thousands. I'm sure it's depending on the network. It could be 17, 1800, 2000, whatever it might be, but it's significantly faster when you take it off the Ethereum network and go to layer 2 and proof of stake. So I still find it fascinating that with all the uncertainty in the regulatory aspect of it, there's just no slowdown in the amount of capital that are going into the crypto companies. Even as fintech has kind of come back to earth a little bit, the crypto companies are just getting flooded with money, and in part because there's just a lot to do.
Yeah.
There 15 transactions a second. I mean, Visa and MasterCard are what? I think MasterCard, we found out last week in an article we did, 25,000. Visa is like 15,000 per second. So that's a big gap. And that's a lot of money to fill that gap to get where those companies are.
Yeah, I think it's super exciting. I think Polygon is very exciting. I think these are all part of what is happening in this space as we wait for Ethereum 2.0. And so you have Polygon, you have Solana on the other side with proof of history. I think it's interesting, all the people involved in this round. So you mentioned led by Sequoia Capital India, but Kevin O'Leary also participated in this round. Alexis Ohanian also participated in this round. I think it says a lot about sort of the kinds of actors that are excited about this. There is a bit of controversy, right? I think there's a sort of the traditional diehards who are always not happy about the way these kinds of systems raise money, right? So this was a private token sale. It drove the price of Matic up by 16%, but it was a private token sale. And I think that's been part of the concern that the VC folks are ultimately owning what was supposed to be this decentralized infrastructure, which is kind of interesting. But the most exciting thing, that's a battle. And there's some, Solana raise also had this kind of controversy around it. I think what I like about Polygon, actually, I don't know if this is widely known, is that, they've been doing lots of interesting things technologically, but this whole thing about zero knowledge architecture and the ability to validate transactions on the chain without actually seeing them, right, effectively. And so that's kind of gearbox future of DeFi that has huge implications for the front-end innovations that would emerge. And I think that's super exciting about these guys. I think there are not a lot of zero knowledge plays right now that are that technologically exciting. So I think it's worth watching these guys for that.
Yep, for sure. Okay, let's move on to this is a topic that we were in Miami for our Deal Makers Summit earlier this week, and a lot of people were talking about this. The advocacy groups wrote a letter to the FDIC, OCC, CFPB, calling on them to ban high interest rate fintech loans, as they call them, and the whole rent-a-bank scheme. And it went into great detail, named 6 rogue banks, actually named the companies that they were partnering with, and called them out for excessively high fees. And they take issue with the whole bank fintech partnership model as well. And I feel like it's just one of those things where, okay, it's like okay, you can ban them. That's legislation can be passed, and this can all be changed. But then, what do you do for the consumers who are looking for capital, looking for credit, and not that demand is not going away? It's only going to be worse for them. They're going through the banking system right now. What are they going to do if their banking system is no longer available to them?
Yeah. I think that. I think we were talking about this earlier before we went live. There's this whole push to try and draw a distinction between what is not working well in the fintech space, or the sort of quote unquote bad actors, and what's working really well in the fintech space. And I was mentioning that there are new associations that have formed. One of them actually very explicitly talks about high interest rate, fintech, and then sort of saying we don't support that, and we are fintechs that have come together that don't support that kind of lending, and we don't like that kind of lending. And so there is this attempt that's taking place, but this is an issue that's been going on for a number of years. I think there's right now with Rohit Chopra at the CFPB, with the changes taking place at the FDIC, I think there is sort of a new chapter opening on this front, especially on the banking as a service banks, and whether this is on flimsy grounds from a regulatory perspective. Does it need to be looked at more closely? The rent-a-charter phrasing is an OCC phrase, if I'm not mistaken, from 2016.
Right.
And so it'll be interesting where it lands. There will be some scrutiny of the space. We've all been anticipating the scrutiny of the banking as a service space much more. But I do think I support the distinction between sort of lending that is excessive and price gouging, and lending that is done thoughtfully in the consumer's interest. And I think we should draw that distinction. I know, Peter, you were saying it's not that black and white, but I feel some attempts to draw that distinction is powerful.
Mm-hmm.
You guys described it as well as it could be described.
Yeah.
Not much to add. I mean, in some ways, it does feel like this is like a never-ending. It's like, this is like the extension of the whole Madden argument, which was settled and not settled, and rent-a-bank. And it feels like this is like the never-ending argument in fintech, especially the lending space, which we've obviously grown our event through, and obviously we've moved beyond the lending space into other areas of fintech. But it just feels like this argument or this is just continuous for many, many years.
Yeah, I have very strong feelings about this, and we're not going to. We're not going to continue. I could talk about this for another 3 hours.
Let me say one more thing. I think the banking, it's been hugely impactful. I think fintech growth has been driven because of banking as a service approach. And even as the regulators try to, sort of say, hey, this is rent-a-charter. What are the connection issues? Who's responsible? Industry is becoming better at managing the risk, better at figuring out who's responsible. There's been so many solutions that have emerged. It's not staying static. And I think that's and this is something the regulators don't always know and fully understand, that industry is also trying to de-risk models. Industry is also trying to improve these things. It's not just coming from external pressure from regulators.
Right.
I felt like I had to say that. I don't know if that helped anyway this conversation.
Yeah, that's okay. So anyway, let's move on. I want to talk about DriveWealth because they were in the news, and this was really interesting. I had the CEO Bob Courtright on my podcast just a month ago, or less than a month ago, and he hinted this was coming. That they're basically, DriveWealth has been all about equity trading for U.S. equities. Anywhere, any fintech anywhere in the world can basically connect with DriveWealth and start offering fractional shares of U.S. equities, and they've done really well out of that. Now they're tackling crypto, and he talks about how there's these 200 basis points of fees you have to charge at Coinbase or more. That's just not sustainable, and I agree with him. It's not sustainable, and he's coming in saying, right, we're going to do it. We're going to do it better. We're going to do it cheaper, and DriveWealth have done very well. They've got a lot of capital, and there's not many fintechs today offering crypto trading, and there's some, but everyone is going to be offering it eventually. Every bank will be offering it. So DriveWealth's well positioned, I think.
Yeah, and many other platforms will be offering it. I think the article talks about e-commerce platforms and the potential of couponing and reward systems around crypto and enabling all of that. I think that's very exciting. And I agree with you. The white labeling of crypto investing seems to be a new frontier where we might see a range of players. And I think DriveWealth is much more sophisticated, very well positioned to do that. I think I mentioned before we got started, Betterment acquiring Makara is also an interesting related story here.
Mm-hmm.
Because Makara has been this sort of interface getting novice crypto investing folks into the space, and so now Betterment will be kind of leveraging the sort of solution. I think they're going to keep the brand. I think that's also another interesting related dimension here.
Right.
So yeah, to your point, Todd, despite all the regulatory uncertainty, all these elements, both the sort of infrastructure elements as well as the sort of expanding access to crypto, just continues.
Mm-hmm. And just like in equity trading, fees came down with more competition, and fintechs help drive those down. Now those fintechs jumping into crypto trading will help to drive down the cost of trading there, and it'll be maybe it's 200 basis points on Coinbase today. Maybe that drops precipitously in the next couple of years. Who knows where that goes and how quick, but this is kind of the natural evolution. It went from equity trading, now it's going into crypto trading.
Right. Yeah.
Okay, we got just a couple of comments here from viewers. Jay Nelson, we appreciate you as well. Thank you very much for watching. And then we got another one from our good friend Bo Bruskern talking about. I think that was where we were the Renton Bank thing, just talking about let's welcome the competition and get back to work. I couldn't agree more. So our last story, I want to just touch on another big funding round, GoCardless. That's a UK-based payment system. They raised $312 million at a $2.1 billion valuation. Some big names there, and they're going to really beef up their open banking offerings, it looks like.
It's interesting. Polygon is $2 billion too, right? They ended up being valued at $2 billion too. Am I making that up? Because it's kind of interesting that you have Polygon, which is infrastructure in the DeFi world,
right?
GoCardless, which is infrastructure in the TradFi world.
Yep.
Are both valued at $2 billion in a recent round. I think it speaks to sort of a big question mark of where this future is and where it's going and the potential there is. And I think open banking is also particularly exciting. In this particular story is exciting for open banking, which we're huge advocates of, that it could potentially only have emerged in an UK environment, in a regulator-driven, that's a question I have. Could you have seen something like this emerge elsewhere? Potentially not. And I think that's a good signal for the rest of the markets that are considering, especially in Latin America, where we had sort of the beginnings of the open banking revolution, that these kinds of businesses could emerge.
Mm-hmm. Okay, well, maybe we can just have one more quick one before we go. Just something that we published on our own LendIt FinTech news site. there was two new fintech funds, the Gilgamesh Ventures by our good friend Miguel Armaza, who was host of the Wharton Fintech podcast, and the Fintech Fund, Nick Milanovic from This Week in Fintech. It's interesting that Bo was actually an investor with Miguel's fund and the Gilgamesh Ventures, and I'm an investor in the Fintech Fund.
We flourishes too in Nick's fund.
Oh, you are? Okay.
Yes, we are.
Great.
And I mean, this is not new, right? I think the story made it seem like it's something, because you have, what is it, Harry Stebbings, right? The 20 VC folk starting a fund. You have Acquired Podcast out of Seattle starting for this approach of sort of being connected. I don't know if does LendIt have a fund that
we've talked about it. We've never really done the work to get it done.
Exactly. The connectors, the bridge builders, the folks that are kind of actually have trust from lots of different parties doing this. I think that's exciting. And I think we back Nick because has sort of connected to this vast pre-seed network, which is great, I think, for venture funds.
And there's this element of real care for the industry. It's beyond just, all right, they can be savvy investors, they're a part of the industry. They've grown inside the industry. There's like a more of a connected tissue with firms like these that makes you think, all right, this is beyond just a play of, all right, where's the best return? This is wanting to help the next generation of fintech entrepreneurs begin to get on that path to real success.
Yeah.
Anyway, we have gone over time. We'll have to leave it there. Thank you so much, Kabir. It's always great having you on. Thank you,
Thanks,
Todd.
Kabir.
Thank you both.
Thanks, Peter.
Take it easy.
Thank
Bye-bye.
you for the audience for watching or listening. We'll be back same time next week. See ya.